Hey everybody, welcome back to the channel. And today we are getting into another one of these research topics in regards to finances, covering for men and women. This is a topic from men, discussion point in which they have brought up as far as like if you want to call it a trending topic, as far as issues with finances. So if you've been following the series for a little minute now, I've been doing a couple of videos like this. So, and bear with me that I'm reading certain points on some of my notes on my computer. So the topic here that men are facing with finances is high risk speculation versus boring wealth, the gamification of investing. So, or almost like saying like the gambling, if you want to call it a different word, it's almost like gambling investment, in the sense of those I'm sorry, having a brain fart, like the high risk stuff. So there's semicolons, so you don't know how it's read out, but it's like the gamification of investment is almost like saying like, at least the way I'm reading it, that high risk right now, because we're in the state of society now where everyone wants to kind of get rich quick, and that's always been a thing, but now more so than ever with the internet, there's so many ways that the traditional way of investing is no longer as appealing. So diving into like the topic points, it says in this day and age, the idea of high risk, high reward, things like crypto, options trading, etc., in younger men has become more appealing than the long game of slow and steady investing. So the old school ways that traditionally usually would get you where you need to be if you started from 20 and you hit 40 was never really an issue. They're saying a lot of people are not really interested in that. And I think a big part of that also comes too with the fact that a lot of people don't get started until sometimes like 30 something, 30 or 30 something, because nowadays like the 30 is almost like the new 20. And I've spoken about this before on the channel before, and I think that affects the fact that slow and steady seems less appealing when someone's just getting started at 30 versus if they were started at 20. Then the idea of hitting 40 and saying, okay, like my money and my finances are looking good at 40 is not as bad as I'm just getting started at 30. And so now my finances aren't going to be looking good till 50, because it's weird, because we're in a space right now where people think 30 is the new 20. It's not, but 30 they think is like the new 20 in terms of I can get started late in life, but yet they almost want the reward way before 50. So it's kind of like you're trying to compress both ends of the time spectrum, and it's not making sense. You can't start late but want to finish early. It doesn't work that way. So, but anyway, key points of discussion is recognizing how modern trading apps gamify risk to profit of retail behavior, deconstructing the get rich quick coping mechanism born out of hyper competitive economy. So essentially trying to, like I said before, like, and that's the topic of the discussion, and this is what's kind of affecting people. And I think for a lot of people, it's seeing it in others make them go, you know what, well, I see someone else that I know do that, or I seen somebody maybe from social media or something like that, and they, kind of got big really quick. I'm doing the traditional way. This person's now a multimillionaire and I'm still doing the 9 to 5. I think it creates that energy even more so, along with the fact that it's publicized on social media. It's publicized, so this creates that dynamic where a lot of people, especially in the younger generation, the older generation already had their time. So a lot of them are now either reaping the benefits of that long, steady race, or they never did it and they didn't make it. So either you made it or you didn't. For them, this is not really kind of pertaining to them as much, even though for more so it's for the younger generation. It says actionable angles, or ways to kind of resolve the issue. It says implementing a core and explore strategy, which is keeping 90% of your assets in an automated, boring index funds while limiting risky plays at a strict maximum of 10% to a portfolio. To a total portfolio value, meaning that like your risky stuff is like about 10% and 90% in your steady. And that can be played around with a little bit in terms of whether that's the right answer or not. I think we're definitely entering a space right now where it's hard to say what is and what isn't the way to go, because like I said, there are so many people who are doing this high risk, high reward, and they're benefiting from it. So there's definitely that as an energy that's going around, you know what I mean? As something that people see and they're going like, I want to be a part of that. I definitely think there are ways to manage it. And I'd say that probably a more of a 50-50 portfolio distribution is probably better when it comes to that, because we are in the age now where with technology and everything changing and rising, that new things are almost guaranteed to make more money nowadays, more so than they ever used to before. So I definitely think that that's a thing. I don't think that it's a thing to assume that that's not the case. So another aspect of things too is how this affects the dating market. I'm always going to bring this back to the dating market to some degree, because it affects things in terms of either your financial goals, what you want, because some of those goals or financial, you being financially well off comes to, do I want to build a family or not? A lot of times someone's like not interested in building a family at all. Well, then really who cares about where you are financially most of the time? Like, I'm not saying some people don't want to do it for the purpose of enjoying themselves. There's always that too, but that becomes a question along with your viableness in terms of people, you even being able to start a family. You know what I mean? Who's going to look to choose you if you are not something? At least this, like I said, this question is coming from the perspective of men, so I'm sure that's an aspect of it. Is your financial goals always lead to something? They're not just arbitrary, just I want money just to have money in my pocket and not do anything with it. There's a goal behind it. So with that being said, comes into the topic of the slow pace way or the traditional way versus the guys who are doing it more risky and getting high reward. Comes into the aspect of, for a lot of men in the dating world, it becomes like, I'm not even considered a viable choice or an appealing choice if you're from your age 20 to 30, you are broke trying to figure things out and do the slow put away and this and that. Obviously you shouldn't be going that slow, but nonetheless you kind of get the idea, versus the guy who, you see it all the time now. Somebody might decide, I'm going to do something on social media, or I'm going to invest in crypto, and overnight, or maybe within like a year or 2 years, they're rich. And so there's the weight of that as an issue. Also, too, there's the slow and steady way of doing things traditionally, but now we're in the space when it comes, especially the dating world now, where people are a little bit more like detached and they don't last that long. People aren't making grandparent age anymore with their significant other. So what's happening now is that long term of you trying to build yourself and get there, and then all of a sudden it being lost because you don't agree with the person anymore that you're dating, or that they don't agree with you, or whatever the case is, and now they decide like, I'm taking you to court, is a thing. And like I said, this is a topic from men, so I'm discussing from a standpoint of men. That's a reality too. So being more financially well off early with the high risk, high reward early, now having your empire, if you want to call it for lack of a better word, already built up before you're with someone, allows you to kind of put things in place and kind of be a little more financially aware of the risk of that long term. Okay, you're going to be like, I'm going to put things in ways where everything's protected because I had it before I met my partner. Whereas if you are doing the long term traditional way, often before you reach the end of the road, as far as your retirement, your closure, like where you're trying to get with everything, you will meet somebody and now you'll start building with them. And then you're not going to protect yourself from them because you're building with them, because you never reached the ending of the finish line in the first place. And so that becomes a thing where you're less prepared for that separation if it goes wrong, which is more highly likely to happen nowadays versus what it would have been traditionally back in the days. But yet, like I said, on the reverse end, if you are financially like well off early, you're going to naturally put in things to protect yourself, because you already know, I established this not with a partner, but separate. So those are things that come into play as well when it comes to this. So all things will always point to the idea of being financially well off early on than being later. But the problem is, how can you attain that? Is the journey to get there safe? Is it worth it? Some people do things where, I used to always say this back in the days too, the road of the starving artist used to be a thing where not everyone made it. Not everyone could withstand that journey of the starving part before you got to the success part. And a lot of people in that, and I use that term relating to any kind of entertainment field. But a lot of times people didn't make it. And if you made it at all, you had to go through that journey of being the underdog or not having anything before you actually made it to the point of having. And nowadays, that concept, so that's why usually that was, I'm not going to use the word frowned upon, but a lot of people wouldn't do that journey. It wasn't the journey that most people would tell you to do, or your parents wouldn't tell you to do. And now we're at a space now where everything's been flipped upside down, where the traditional way is not even necessarily the better way, because that now the starving artists, well, with social media and whatnot, people just put in the work, and sometimes you make it regardless, and making it is almost as guaranteed as you trying to make it doing the 9 to 5. So definitely things have been thrown off from what we normally felt, things should be the traditional trajectory. But I would say that though that is definitely a positive, if you could have that or sustain that. But like I said, the negative is there's still that starving artists, and we'll transition that over to the high risk, high reward concept. The starving artist concept still applies, where it's like you might be trying to do this high risk, high reward, and things go bad, and you're back to square one. You're doing it again, until it finally jumps off. If it jumps off at all, if it doesn't, well, then that slow and steady would have finished the race, and you haven't. So there is a risk to that. So I get the concept of that topic. I would say the best solution is a 50-50 approach. Try to have multiple things going on in your life where you're high risk, high reward, while also doing your steady 9 to 5, half of that. You know what I mean? So for example, a good example is this. If you're doing 9 to 5, take a bit of your money and invest in. We've done that before on this channel as far as breaking down finances, breaking down, savings, budgeting towards investing and whatnot. And sorry, you guys, hiccups. And the importance of that. So definitely that's something to kind of really like grab hold of and really kind of understand like that basis and bring it in that direction. And knowing like, okay, you have to sometimes multitask with doing your base work, your 9 to 5, whatever you're doing, and then saving on the side where you're able to then put that money to investing, whether it's stocks and bonds type stuff. Well, not bonds, but stocks. What's the word I'm looking for right now? I'm sorry, I'm having a brain for right now. But various types of stocks. I'm trying to think of what I'm thinking about right now. Not ETFs. ETFs is that I'm having a brain for right now, so I'm trying to think in my mind in regards to that. But yeah, the various types of stock portfolios that you can get together and put together, and jumping into those, as well as maybe jumping into real estate early. We spoke on that before in the past, ways that you could jump onto that. Or whatever it is that you can get into. If you want to dive into the social media, financial social media space, you could do that as well. And just trying to find that way, but do that while you're also doing your 9 to 5. Don't just rest on the 9 to 5 anymore. In this day and age, in the past, it was something you could do. In this day and age, I don't think it's something that you should be putting all your eggs inside that basket anymore. So any thoughts you guys have, post them down below. I'd love to get the discussion going with all you guys, especially if this is a space that you've been feeling like you've been in that kind of space or thinking about this in your mind. Like I said, this was a researched topic of discussion that was coming from the space of men, generally speaking, from their 20s to 40s. Let me know if this is something that's been plaguing you. Put it down in the comments down below. We can have a discussion on it. As always, you guys, like, share, comment, subscribe, and I'll catch you guys in the next video.